This student made $1,575 last month in December, and I'm going to show you how he did it. He traded only for 6 trading days, as you can see here, for 1 or 2 hours. In the US time, it's going to be 9 a.m. Between 9 a.m. and 4 p.m., 1 or 2 hours, free selectable. In this case, because he's from Germany, he was trading from 6 p.m. to like, as you see here, from 6 p.m. 40 to like 8 p.m. 15. And from 8 p.m. sometimes to 10 p.m. And I'm going to show you something what you can also do by yourself. That means how you can use it also for your own trading. First of all, we use always a weekly method and also a monthly method. It means you can see here within a month, the trader was earning $1,575. The money management is something what is very important, that he lost 6 times, $50, $70 around. So he lost $350 in total, but he was making 4 times. He had 4 winning trades, and in total they were $1,925 worth. So the money management is something what is very important. When we just go here inside, this is the S&P 500 future, what is very important. We always use a 3-step method, and if you do this 3-step method, this is how you can improve your trading, because we day trade futures because it gives us just a lot of leverage. That means when we see that the market did this move here within the last hour, that means from here to here, and we would just assume that the market does the same move again, just like in the same direction, then this could be a $2,000 to $5,000 move. And of course, for us, it's a clear target that the market wants to go to this bigger structure high here. So now we estimated cash flow a bit, because there are days where it's more easier to see it, and there are days where it's more harder to see it. And on this day, it's, I think, more easier, as you see here, because the last hour, the market was very aggressively going up higher. The market was reaching already this high, and because the market was reaching this high, because you can see the market does higher lows, we call this one, we assume that the market continued to do higher lows and also higher highs. That means that the market wants to go here, and then afterwards the market wants to go here, what makes a lot of sense. And this is what the trader was showing me here, that in the first 5 minutes when the trader is trading, he assumes that the market is doing here a $2,000 to $5,000 move. So in the end, the trader was also doing a picture, and you can see here exactly what the market did. The market did not reach here this bigger structure high right away in our time. But what the trader did is literally, what the market did is the market was going in that direction. That's literally here a $1,000 movement, a $1,500 movement. So what the trader did is he was having 2 opportunities, actually more than 2 opportunities, but he traded here, adjusted here $100, and he lost here $100. But here, for example, he adjusted $100. This was a $500 trade, for example. When we just go to the Excel sheet, because he's right now, I'm not sure, I just need to check this here right now. He was just losing $25, as you can see here. And with this trade that you just saw, he made $688. That means he finished this day he made $662.50 for this day, almost including commission. The commission is just like $6.50 for each trade. So it's pretty a lot of profit. That means making money for this day. Another day here, you can see here the trader starts to trade, and he wants to trade it for 1 or 2 hours. So this is the line from here to here. That means 1 hour, 1 minute chart are 60 candles. That means until here we have 60 candles that are finished. And when you look now at the last 1 hour, you see that the market is just wiggling around here. So those are harder days to trade. But if you have enough experience and understand that the market is falling, this yellow line, what you can see here is the one day VWAP. This is the volume weighted average price, is something what is very important. That means it's just an average price of the day. And you can see how the average price is falling. That means that the market wants to go cheaper. And every time the market was above this yellow line, you can see here that the market spikes up and goes down again. Spikes up, so we assume that the market goes down. I really love this, great. This is something what you may only can see if you have a bit market experience. This trader has like 5 months experience already. So instead of that the market was going down this strong here that you can see here, the market was going 45 and a 45-degree angle down. But this is still a $1,000 or $2,000 movement with enough leverage. And you can see here how this trader made, here he lost $62 2 times. And the third time he made 9 times. So you can see here the risk reward ratio was 9. We can go here inside into the Excel sheet, and you see here that the trader lost here, you can see here how he lost here $62 2 times. And then after that, he made with the single trade $562. So he was finished for this day with $437 he made there for this day. And this is something what is important to understand. By the way, there was also another day he was analyzing. We're going through this and he was not placing here a single trade, because you can see here there's this learn trade, LTP analysis, those are different kind of things. What was traded with real money, or just like here the trades. Very important, no financial advice. Please do this with a demo account. Here, for example, we see that the market was going up, right? And if the market would, because here the market was going higher here, average price just exactly the same. The market was going under this average price and then just like pops up again. That means when the market goes here, we still assume that the market pops up. We just assume, because the last hour the market was going this high, that the market does just the same thing over again. So we assume that the market will go up here. I think that makes a lot of sense. What I really like is, because we have here a bigger structure high here, that the market, once the market reaches those targets, and here's the next targets, what happens very often is that the market is consolidated here, harder trades to find. And then once we can see that the market pushes up again through a lot of green candles or higher rotations, that means like just like higher lows in this case when the market is going up, lower highs when the market is going down, then trading up to this target. Let's just see what just happened and what the trader did here. You can see here how the market really literally had here struggles, because the market reached here this bigger structure high already, then just turned around, and then you just can see here how the trader here had an LT, an A1, an A2. That means the person was just analyzing. He knew exactly what is going on here and that he has a hard time. By the way, if you want to make day trading for a living, like that means like as a part-time job first, that means after you work, before you work, or something to live off, then you can just sign up under this video at tradewithjt.com and I'll reach out to you and I'll look forward if I can help you. What I do is I trade with the person together, I give him exercises, and so far it works so good. That means you first learn how to duplicate a demo account, that means a not real money account. And from there on, I will help you into the transition as he does, for example, with his first real money account. Then don't worry, you're not going to burn any money first. It's going to be first a not real money account. And then afterwards, people start with $500 to make your first $100 to $500. And then afterwards, they're starting with $3,000, $10,000, $30,000. Depends on what money they have available. Of course, on their own decisions, but it's just something what works very nice, what you see here with the YouTube videos. Okay, let's just go on with the video topic here. We have here, so here you can see the day we just looked at that the person was just analyzing. And here the trader was placing 3 trades. He had 2 losing trades of $62.50. And then he had 1 winning trade of $562 and made $437.50 for this week. Let's just go to the other week. So here the trader saw that the market was going up and he was assuming that the market goes higher. Then you can see here the market had here issues. That was the one he was analyzing, what we just talked about, right? He didn't place any trades. And now we go to the next week. And this is where you see that the market is falling. So actually, when we see past hours, the market was falling. We just assume that the market continues to fall down. But here's the big problem. If you see that the market has here a lot of time in this area, and now look at the VWAP. VWAP, the volume weighted average price, calculated by CRIM, you see here that it was racing up and price was falling. So there's something wrong. That means actually the average price was rising, but the market is falling. So that means this is not real that the market goes down. The chance is very high that the market goes to this yellow line. And this is exactly what you see here in the drawing, what the trader also expected. Now let's just see what just really happened. You see here the market did not make it up here. The market was falling, and you see here that the market is also rotating lower. I would have assumed also the same, that when I see that even though past 3 or 4 hours that the market is going down, I would still assume that the market is going down, but somewhere that it's just getting harder and harder, and actually the market likes to reverse to this average price. And let's just see what the trader did here. You can see here how the trader was not selling here, and I think that's very smart. And what the trader did, he bought once he saw that the market was going up, because that was his trading plan. You see here how he lost here. It was like T1, he lost here $75. And then with the second trade, he made here his money. We're going to see in the Excel sheet how much money he made here, that you can see here. That means here he lost $75. And with the single trade where the market was going up, he made $375. There was another day where he made $300. That means we're going through also the other day here. That means here's another day. The trader saw that the market was going up here, down here within 1 hour, and then just like a bit like here, just like a consolidation. And he assumed that the market continues to go up. Maybe just touches here the average price here, and then again goes down. And let's just see what just happened. You see here, the market was touching the average price. This was the trading plan. And from here, the market was going down. So he should have traded here. Let's just look at this one. And you can see exactly how he also executed it perfectly. He didn't even trade it here, because here are a lot of green candles, what is pretty devastating. And that's not good just to enter here, trade and sell. He waited until there are more red and green candles and then traded here the color switch, adjusted $100 around. This is the $300 trade. In this case, he was adjusting $50 for this trade to make $300. That means his risk reward ratio equals to 6. That means he can have 6 more losing trades for this winning trade. And this is something what is very important. And this is exactly what you just see here in the Excel sheet. That means on this day, he made $300. On this other day, he lost $75 and then he made $375. Let's just go on. There was also one losing week of $125 loss with 2 times, like here, a $50 loss trade and a $75 loss trade, as you can see here. Let's just go here. And you can just see here that the market here is a bit like the average price is going up. The candles, the last hour, the market was going lower. So it's like average price is going up, price is going down. And those are just two forces that are fighting against. So it's just like not that congruent. And you can see how the market really was also going down and then also up. And then the trader had here a losing trade. The trader was trying to buy here. The main problem was here because there were 4 red candles. And every time you see that the market is going up, it does more than 4 or 3 red candles. If it's just happening once, it's not a big deal. But if it's happening twice, like here, first time, second time, this is where it gets exactly dangerous. The trader even placed here 2 trades, as you see here. It's like first trade lost $50, second trade lost $75. And this is just something what can happen on the practical side. But it's just like the trader knew already that this day is not that qualitative because, as I just said in the beginning, the average price was rising and then the price was going down. And mostly you can see these problems before you start trading.